What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome to the Advisor's What's Making Headlines podcast for the week. It's been a really busy week of headlines and news here on the Advisor and our sister publication Broker Daily as well. I'm your host for this week, Charlie Tchetchenian, senior journalist on the Advisor, and we've got my colleague Ben Squires here as well, featured content writer on the Advisor. How are you, Ben? And how's your week?
Yeah, good, thanks. We sent the May magazine off to the printers this Monday, so that felt like a good one. Good way to get the week started. And then there's a lot of big stories this week too. So what's going on?
Yeah, there were. We crammed it in pretty well. We have our editor back from the Better Business Summit and Awards, Annie Kane, and she took on a lot of massive stories this week in relation primarily to fraud, and we'll have all the updates for our viewers and readers a bit later in the podcast. But yeah, I got to speak to a lot of kind of brokers around the country this week about a range of things. So I'm really looking forward to getting stuck into that.
Yeah, maybe the first one we sort of talked about, and I think this went out in our Monday bulletin. But
it was earlier in the week, Monday. Yep.
Yeah, you sort of reported on. We saw some media reports about sort of retention tactics from one of the major banks.
Yep.
And we really wanted to get the broker's perspective on how they sort of saw this. And
100%, because I think the reports themselves were flagged by brokers.
Yeah.
That it was ANZ, the major bank. There were kind of reports that it had kind of recommenced its targeted retention payments of broadly about $2,000 to borrowers who were midway through the kind of refinance process, actually late in the stage of a refinancing, and had already lodged a discharge form. They were then offering these retention payments to kind of obviously refinance to another lender. And this is something we've been hearing about a lot. A lot of the major banks phased out these kind of tactics late last year, except ANZ. And they're also waiving some fees in relation to kind of competitors' pricing by about 15 to 20 basis points as well. And yeah, there was definitely a sense of frustration from brokers that the banks and ANZ in particular is employing this kind of technique, especially so late in the process.
Yeah.
When a borrower is basically already out the door.
Yeah.
And kind of borrowers unimpressed that the banks are leaving it until the very last minute to offer a best price.
Yeah, the comments you got for this story were really insightful. I think so you spoke to Matt Turner from GSC Finance. He's a partner and managing broker there. And I think what he was saying is it's not the issue that the ANZ is and sort of a lender in this situation is competing hard for customers, but it's the issue. It's the timing after a broker has put in all this work and got to this late stage.
It's a bit peculiar, isn't it?
Yeah, because the broker always wants to feel like they're putting the best possible offer in front of their client, and then to get gazumped at the last second is incredibly frustrating.
100%. And yeah, he basically said that it's kind of evidence that the system is flawed.
Yeah.
And what really perturbed him was the point in which the banks were choosing to throw out these cash payments and dangle the carrot. And he basically said that these methods, and to be fair, they're used by a range of smaller scale lenders as well. Has basically forced him to rethink his entire process about surrounding retention and discharge times. And he said it was cutting into a lot of his hours, and they were kind of baking it into their process now and educating their clients and providing them with scripts when engaging with retention teams and educating them on how much the bank had kind of overcharged them while the loan had been there by not offering those best rates.
Yeah, exactly.
Which I think is really good.
Yeah.
That there's that advocacy there from the brokers as well.
Yeah. And it's you had some other comments in that story from Daniel Kaminsky, who's senior broker at Loans for Homes, sorry.
Yep.
And he sort of just talked about the frustration about the amount of work that's done. So he sort of quantified it. He said it's probably 10 to 15 hours of work,
which is
risk.
a lot.
Yeah.
That's a lot of labor that's biting into.
Yeah.
And it just shows how common and kind of proliferated
it
is as well. And I called a lot of brokers about this.
Yeah.
And obviously it's a bit of a sensitive thing and you don't want to kind of point anyone out specifically.
Yeah.
But it was a broad-based general source of frustration, I think, which is interesting.
And you totally get their frustration. And I think it sort of speaks to the ongoing sort of conflict between, the broker channel and the direct channel as well. But
and it's only kind of natural as well.
Yes,
as is always that the banks are going to compete hard.
And in a sense, I mean, they're kind of entitled to, but I guess we're just sort of trying to figure out the best way.
Yeah. And he kind of Daniel said as well that likewise this had triggered a different kind of process from his team, obviously depending on the lender and the product.
Yeah.
Including sometimes before submission or submitting a fast refinance where a discharge wasn't needed.
Yeah.
And he basically went, look, if banks are willing to outlay thousands of dollars to keep a client, they should also recognize the efforts that have gone into presenting the alternatives as well, that being kind of broker contributions.
Yeah, 100%.
As well. Very much, and all the kind of effort and expertise that have gone in behind that.
Yeah.
So interesting topic. I'm sure we'll be hearing more about it, as well as we get some more reporting around that. And we heard a bit more about how discharge processes can be reformed, a bit from the MFAA as well at the Select Committee for Productivity. We'll get into that a bit later. But looping back to discharges, so a couple kind of stories related to that this week. But also another kind of coalface story where I got to speak to brokers, and it was a really fascinating one. Was the loans that brokers are opting not to write, or the kind of process of saying no.
Yes.
And saying no or turning away clientele for various reasons is sometimes okay. I spoke to 3 brokers on this story, and I got some specific takeaways kind of loan types, that being trust lending. And I spoke to James Algar, who's the franchise owner at Mortgage Choice DY, up on the Northern Beaches in Sydney. And he kind of said that the clearest example over, both recently and long term was his own practices, in kind of shifting away from a specific loan, was using, like borrowers determined to build kind of large portfolios using multiple trusts. And
he was talking about a situation where a client was trying to over leverage themselves, that kind of thing.
But he was also speaking about trust lending in general, as well, and how kind of complicated and risky it's become. We've obviously had moves from APRA to curb high DTI lending and activating limits that would cap new share of mortgages written at 6 times income or above. And he was talking about, clients over leveraging themselves to the point where it's very dangerous.
Yeah, exactly. And at that point, when you're sort of trying to do everything within a bid compliance, I think, it gets a bit too hard, I suppose.
Yeah, it gets dicey. 100%. I also spoke to Daniel Liao, Mortgage Choice, broker in South Brisbane. And he kind of took a more conceptualist take about, the art of stepping away from particular clients or loans. And he said, his quote was, "Good brokers turn away loans all the time." And he kind of said that his own decisions to walk away from a client or a loan wasn't really around a single credit metric, but more on kind of behavior and expectations of the borrower behind it. And sometimes if a client and a broker don't mesh.
Yeah, it was interesting when he was talking about where the client is potentially asking, him to breach a boundary that he wouldn't want to breach, and sort of a loan that doesn't align with their values and that kind of thing.
Yeah, and there's compliance crackdowns.
Yes,
we're seeing that at the moment. Obviously from ASIC. So, brokers potentially being put in uncomfortable situations.
Yeah.
It's good to see that they're playing very much so by the rules.
Yeah.
And yeah, you were saying that as well. It's kind of a personal thing as well. If the situation isn't right and the values don't gel, personal boundaries had emerged alongside tighter regulation framework. So he kind of referenced both of them. Yeah. But he also spoke about bid a bit, which I thought was interesting. And he used the analogy of comparing brokers to a banker, and he kind of just went, look, they'll either find another broker that's willing to do it, or if not, they'll go to a banker because the banker doesn't need to worry about best interest.
Yep.
So, brokers are compliance bound here.
Yeah.
And it just shows that, they're being selective for good reasons.
And I suppose it's encouraging that they're making these decisions with this sort of bid framework in mind, and that's what it's there to sort of encourage.
100%.
Yeah.
And yeah, I there were a lot of takeaways from that story. We spoke about a lot of things. I spoke to Tony Gia as well, who is the director of the mortgage agency. They've got multiple offices in Sydney and other cities as well. And he spoke about trust lending as well. In addition to James, he kind of went, look, his team has drawn a line under trust transactions altogether.
Yeah.
And his team is now refraining from writing them over the past 3 to 4 months, and is making that kind of clear upfront to their clients. And, the major banks have been, for a while now, tightening access to loans in the name of trusts and companies. Moved from ANZ, Commonwealth, Macquarie, all moving to either restrict or curb it altogether. And he's basically gone, the problem isn't trust itself, but the sheer kind of labor and work that's involved to spearhead it.
Yeah, and he was talking about like how time consuming these deals are for the business.
Yep.
And he was saying it's due to the fact the majority of consumers wanting to purchase or inquire about buying under a trust don't really understand the logistics.
No,
I think. And
no.
That's a really interesting point.
And there's some, I think he was saying there's some misconceptions there as well about what's involved.
Yeah, I mean, we've reported and written on this quite a bit, but I guess there's been like this sort of rise in influencer stuff. Someone might have seen a post on Instagram and LinkedIn.
He was saying that, borrowers are potentially being led astray on social media about the benefits of trust lending. They don't actually understand what's involved and how sophisticated it is for a broker to make that work, where it simply might just not.
Yeah, 100%.
So, and I got some good insights out of brokers as well this week, whether it be if they're turning to non-banks with the kind of rising interest rates and the credit squeeze. So do go onto the website and check out those stories. There was a pre-approval story as well, a lot of comments and analysis from brokers all around the country this week.
Yeah.
When we come back after this short break, we've got a myriad of updates on the mortgage fraud front that is engulfing the industry. We've got some updates from all of the aggregators as to how they're enforcing compliance and keeping things in check. So we'll be right back. So Ben, we had a couple of updates this week with this ongoing kind of mortgage fraud episode that has been playing out for a couple of months now. It obviously started with the Commonwealth Bank self-reporting potentially what was then perceived to be $1 billion in bogus loans, fraudulent loans, which now reports suggest is much larger and involves a lot more banks and deposit-taking institutions, and we've got, now ongoing fact-finding missions and intelligence sharing kind of programs with Austrac and ASIC and APRA are now investigating with the major banks and also some of the other kind of top 10 lenders as well. However, there have also been aggregators implicated in this mortgage fraud scandal as well. We had obviously those reports and articles put out by our editor Annie Kane about the fact that Finsure brokers are potentially implicated in this scandal. So a lot of good work this week from Annie about speaking to the aggregators directly, seeing what they're doing, seeing how they're kind of tracking this and how they plan to respond. So I think we should start with LMG. Australia's largest aggregation group, LMG, confirmed to the advisor this week that it had confirmed that it was investigating 2 matters relating to alleged fraud, but it flagged that the conduct in question appeared to come from referrers.
So the referrers sort of operate outside the regulatory framework that covers brokers within the network. For example, they're not subject to bid, licensing requirements, or mandatory AFCA membership. LMG told TA that the first matter sort of relates to 2 commercial brokers who were referred to ASIC by a lender. And both brokers have been suspended immediately and remain under investigation. And the second matter refers to 3 resi brokers who had been previously terminated, and 4 brokers who are currently suspended and under investigation. So there's a bit going on, a bit to unpack. Apparently in the second matter, the brokers were suspected of lodging fraudulent tax returns, pay slips, and banks statements provided by a referring accountant. So it's quite similar to what we saw in the reports from last week as well, kind of like getting this sort of...
and multiple kind of professionals implicated through that referring channel
and
as well.
We had some comments from LMG's CEO and Executive Director, Ewan Stafford, who said, when issues arise, we sort of act immediately, including suspension, investigation, and where warranted, termination and reporting to ASIC and the lenders. They've got a zero tolerance approach. It was really interesting to sort of see within the story what happens when a broker is under investigation. They sort of, LMG unpacked a little bit. So according to LMG, if a lender contacts the aggregator to outline suspicions of fraudulent activity, the aggregator will triage the risk and determine whether it's a case of immediate suspension while the investigation is ongoing. If they're suspended, a broker is unable to access My CRM. And they will also be unable to act on any discharge forms or provide any documentation to the lender that reported the fraud.
And then they go and do the work and
do their
kind
own
of,
investigations and due diligence.
Whatever it may be, view the files and compliant history and that kind of thing. So like you said, it's good to see the work that's involved once misconduct is flagged.
But it just goes to show you how tricky it is for the aggregators, for the brokers, and when you're working with these referral partners and you're receiving this documentation, I guess you can't take anything on face value anymore.
No, absolutely right. And these documents, whether they be fraudulent or not, are becoming a lot more sophisticated in terms of doctoring them or generating them through AI. Whether AI doctored payslips and income statements and tax history is becoming a lot more prevalent as well, and something that brokers and lenders are seriously grappling with.
And
it's scary.
It's scary, and it's a whole of industry thing, I think, as well. It's not a probe of the aggregators.
No.
It's something everyone's got to sort of figure out, I suppose. But and no segment of the industry is immune as well.
No. And in addition to those kind of specific updates at LMG, we also got some more information from a range of aggregators as to how they go about kind of isolating potential fraud and discovering it, but also what they want to see moving forward, and they're obviously calling for a better data sharing regime between them. We this week spoke to a number of senior representatives from the aggregators. We had newly appointed David Flynn, Chief Risk and Compliance Officer at Yellow Brick Road.
Yep.
He's only been in that job for a couple of weeks, if that.
Yeah.
And he's got a pretty tenured career in risk and compliance, and he kind of said that the current focus and action from regulators on detecting loan fraud was both necessary and appropriate.
Yeah.
He supported these initiatives and measures that kind of strengthened document verification and income data sharing, and also backing in collaboration, like you said, between the entire lending ecosystem itself. We had Mortgage Choice CEO Anthony Waldron, who said the group wasn't currently investigating any of its brokers, and it hadn't been asked to investigate any Mortgage Choice brokers as a result of this fraud probe. We had Brad Cram, Chief Distribution Officer at Lendy Group, and also newly elected Deputy President of the MFAA's Aggregator Forum. He told the advisor that no broker within its network had been identified in relation to the probe. And he said the group was regularly engaging with lenders and regulators to information share. And we spoke to a lot more kind of representatives from the aggregators in addition to that. It was a comprehensive kind of check as to if there's any misconduct flagged, and also what they want to see moving forward. So I highly encourage
they should definitely
our viewers to go and read that story.
Definitely. I thought we also had some comments from Daniel O, who's the group legal counsel at Connective Broker Services.
Yep.
And he was sort of saying it's not a mortgage broker channel. It's not even a third-party channel. It's linked to the bank's proprietary channel. But he pointed to this sort of chain of custody over documents as a critical control, particularly when you've got falsified pay slips.
I know.
And the ability to generate sort of fake bank slips is becoming more sophisticated.
Yep.
He said fraud is everywhere. No channel has a monopoly on fraud.
Yep.
But he said that's why Connective is increasingly sort of pushing their brokers towards sourcing information through secure channels, such as open banking, as we've sort of talked about before.
Consumer data, right?
Obtaining documents straight from the source when they can to reduce the risk of manipulation. I think with any sort of industry where there's so much document handling, it's just you've got that risk. And
and it's on such a large scale as well. And it's so hard to kind of definitively keep track of it. And these industry bodies, including the MFAA and FBAA and others, are constantly pointing to these single sources of truth, like obviously widening the CDR and, to incorporate ATO data and tax returns and asset company registration data and so on. So this is going to continue to play out. Kind of from an authority perspective, the referrer and introducer programs that a lot of the banks, including CBA, are still operating despite controversial episodes and histories. We had a solicitor charged this week for alleged involvement in multi-billion dollar fraud scheme. When you actually look at what's involved here, it's quite massive, isn't it? This 32-year-old solicitor who's been named. this 32-year-old Sydney-based solicitor who's been named was arrested yesterday, and he was charged with 6 counts of dishonestly obtaining financial advantage, etc., by deception, 5 counts of knowingly dealing with proceeds of crime, and participating in a criminal group contributing to criminal activity.
Yeah, I think the reports have said there was allegedly assisting a syndicate to help the group purchase multiple mortgage properties valued at more than $25 million.
Yeah.
So it's not a sort of drop in the pond. But,
no.
It's pretty shocking when you sort of read about the fraud in these reports, and then you actually get detail as to what it actually looks like in real life. It's
and this arrest as well forms part of Strike Force Middleton, which is an investigation originally launched into criminal syndicate targeting automotive and finance companies. However, it's kind of initially uncovered that the syndicate was allegedly using stolen personal data to further apply for loans through various financial companies to purchase these luxury ghost cars that did not exist. And it kind of goes to the point that the referrer channel and these mortgage loans, these fraudulent mortgage loans are being written to kind of wash criminal proceeds.
Yeah.
For various reasons, whether it be for drug trafficking or sex trafficking, really nefarious reasons behind it, using these loans to back kind of criminal enterprise, which puts a chill up your spine, and is obviously something that the regulators are very much wanting to investigate and see how kind of broad.
Yeah,
and concerns that it's being used to funnel proceeds offshore.
Yeah,
as well, which is pretty concerning.
Yeah, and we'll keep reporting on these sort of developments as they unfold. But I'm sure we haven't heard the last of fraud in 2026.
No, absolutely
unfortunately.
not. I have a feeling this is gonna drag on for quite a while. And again, in today's kind of increasingly sophisticated digital environment, it's concerning to see that artificial intelligence is being used to con and dupe these lenders and brokers as well. We'll be back after a short break to touch on some updates from the peak bodies and what they're calling for. And also we've got some updates on the government's 5% deposit scheme as well. Stay with us. We'll be right back. So this week, Ben, we had the MFAA CEO, Anya Panak, who appeared at the Senate Select Committee for Productivity.
Yeah.
And we had a flurry of submissions a couple of months ago from a whole range of groups, whether they be regulators or peak bodies, a lot of housing groups as well, to kind of get their thoughts as to how the country can pull itself out of this productivity malaise that we've found ourselves in. And it was really interesting to hear what Anya had to say. Obviously, she was kind of touching on, reverberating the recommendations the MFAA made in their submission in late Feb.
Yeah.
But it was good to see committee members and senators kind of see what is interesting them. A lot of questions about the 5% deposit scheme.
Yeah.
But yes, also a lot of focus on discharge process and how this can be reformed and made more effective.
Yep.
So yeah, what were the kind of specific points that the MFAA made?
Yeah, so she was talking about how the allocation of capital is really important to sort of support investment, labour mobility, broader economic performance. But what she was critical is the current discharge and refinancing process as an example of a situation that when the system is kind of constrained, it diminishes productivity.
100%.
So what she said was, friction in refinancing and delays in the discharge process all act as barriers to switching, reducing competitive pressure, limiting mobility, and increasing the costs for borrowers. So what she has suggested, what she and the body suggested at the hearing, to fix the discharge process would be a mandated 10-day discharge time period.
Yep.
So if a borrower were to seek a discharge from their existing lender, the lender would need to process the discharge within a 10-day time period to provide certainty.
And that 10-day discharge required process has been something that's been called for a very long time.
Yeah.
And out in the kind of and we saw that as a specific recommendation from the ACCC way back when it released its home loan price inquiry in 2020. It specifically recommended that the government force all lenders to be subject to this 10-day business day requirement to complete these discharges. But it wasn't taken up by the Morrison government then, and there's been no mention of that specific recommendation by the current Albanese government. Jim Chalmers, the Treasurer, tasked his department to examine the findings of that inquiry and report from the ACCC. However, no mention has kind of been made of that. Which is a bit frustrating.
She also had a recommendation, it's kind of focused on that pattern where borrowers are drip-fed offers that kind of like what we were talking about before, but that did not reflect the lender's genuine best rate, and that sort of stretches out the discharge process as well. Sort of makes it it's very confusing for a borrower, and in essence delays the discharge time period. So sort of figuring out ways you could refine that. And the third sort of plank was allowing brokers, with the consent of their borrowers, to manage discharges on behalf of that client, which could potentially be a solution. It'd be interesting to see what our readers sort of think about that and whether they've got some thoughts. But it was sort of some interesting proposals there.
She mentioned a kind of a lot of pesky back and forth tactics that the banks use to elongate the process, and she kind of zeroed in on that as an obstacle which lengthens and these discharge processes. And she kind of said, well, look, if it's clear consent from the borrower for the broker to act on their behalf in a professional manner with these discharges, then that's something that should be enacted, that they think is going to free up improve those delayed discharge processes. And she spoke about a range of things as well. She was pressed on serviceability buffers. Funny enough, APRA also spoke a bit about that as well today. They basically said, look, we have no intention
to change it.
Of changing that at all. But I thought Anya's points here were really interesting, because she kind of said that, while this is on its own point, the MFAA has kind of previously urged a targeted rethink of the buffer. She said that like flexible uses or flexible kind of flexible settings could better reflect changing rate cycles. So she was asked whether the buffer could act more as a fluid moving band with an increasing or kind of decreasing rate cycle. And she said yes, in essence, a more kind of dynamic buffer in upward or downward cycles would be more kind of effective moving forward.
This is something the MFAA have sort of called for, and sort of other industry bodies have sort of called for before. But I think the buffer is there to protect borrowers 100%. As well.
And she was saying as well that it's in kind of exceptions. and she said that her members were seeing the kind of the banks lower the buffer in certain exceptions was being used effectively in some cases, and that borrowers were meeting all of these requirements and all their payments with their kind of existing lender. And obviously it's not an across the board thing as well. It's very like targeted and specific on a borrower's kind of situation, and if the bank is willing and able regulatorily to make a concession there, and sometimes they are. And we heard that from committee members and Anya. So a lot of takeaways, interesting takeaways here from her appearance at the committee. She kind of also spoke about the consumer data right as well, and expanding that. She spoke a little bit about open banking too, and that brokers were seeing a lot of success with home loan applications on a case by case basis of open banking, and that kind of prioritizing this moving forward was key for the body. So once again, go and read the article and go and read the MFAA submission as well, because there are a lot of things about, and I'm sure brokers will relate to this, of a lot of double up in terms of submissions to regulators as well, where there was a bit too much red tape or regulation could kind of be improved to bolster productivity.
100%. It's definitely worth a read. And that was pretty much that was most of what we had for this week.
It was a busy week. A lot of compliance.
A
lot of kind of updates from the regulators as well. We couple of other things as well. We obviously had more data updates from Cotality on the 5% deposit scheme and what's happening in that space. And this was a story that I took on and kind of just an interesting topic that's garnering attention is the fact that these lower priced homes under the set price caps of the 5% deposit scheme were surging, and in many cases were surging in value more than the upper quintile.
It's a super interesting report, and I think like the timing of the data set as well is kind of what makes it interesting as well, because we're just sort of starting to look at the scheme and sort of get a sense of its efficacy and that kind of thing.
Yeah, it was expanded in October.
Yeah.
And obviously a lot of those approvals and pre-approvals have now passed.
Yeah.
We had the scheme top 300,000 users in all time.
Yeah.
A big milestone. And a lot of brokers that I've been speaking to recently telling me that their clients are despairing because, not only they can't meet market prices, but they can't even meet the cap prices. And they differ obviously in regional areas and urban capitals.
I just want to do one podcast one day where we've got good news for first home buyers.
I know that hopefully that day will come. But yes, go and read that. Go and read that story as well. It was basically reflecting in statistics what brokers are saying they're seeing on the ground, and that is the fact that 81 of 88 kind of local level market areas, the values for undercap stock are outpacing high-priced homes. That's a resounding majority.
It's so interesting because I think your report said at the end of September 2025, 48.6% of suburbs nationally had a median house value below their local price cap.
Yep.
By the end of March this year, that has fallen to 39.5%, which is a little bit of a worry.
So less options. And brokers are telling me that this is resulting, funny enough, in more or less more supply, or kind of land packages at the outer edges of suburbs to see how borrowers and scheme users can compromise to fit within the requirements. And it's definitely generating demand at that lower priced segment of the market, and it's also generating. We're seeing that in lending statistics as well, from APRA, that low deposit and low deposit lending, but also lending among first home buyers is through the roof, and is at levels hitherto unseen, basically. So it's all a resounding 3-point check there on the ground kind of observations, but you've also got those, statistics and data to back it up as well. And this is something we all need to keep an eye on. It was the topic of conversation for the RBA and Treasury and the Productivity Commission and APRA at that select committee as well. All anyone wanted to ask was, are borrowers over leveraged to a point where it's going to become unfeasible for them on a kind of debt to income and loan to value ratio? And APRA didn't seem too fussed. However, it's still one to keep an eye on.
100%. And we'll keep reporting on these sort of data sets and changes and tweaks and everything as it sort of becomes available.
They're always incremental tweaks.
Yes, that's always okay.
Well, thank you for coming on the show, Ben. Obviously, just the two of us. A lot of news to sort through this week, and I'm sure that's a trend that's just going to keep on continuing. So if you do have any tips for us, any ideas, any pictures at all, please contact me, Charlie Tchetchenian, or our managing editor, Annie, or Ben, or Julian on Broker Daily as well. We want to hear about it, and we want to report on it. Thanks so much for being with us. We're going into Anzac Day. We've got a public holiday
in New South Wales.
On Monday. That's nice.
That'd be nice.
A concession made there from Premier Mins. Unlucky that it happened to fall on a weekend this year. So I think a well-deserved break for everyone down in editorial.
New South Wales editorial.
New South Wales editorial and everyone else in the state, and for all the brokers out there. Whether you're taking a break, whether you're not, pull your feet up. You deserve it.
Yeah, exactly.
But thanks again for tuning in. As always, we'll be right back next week. Thanks so much. Have a safe weekend, and catch you next week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.